And it is Friday and the market is tired heading into a long weekend and it's hitting resistance. We're going to be breaking it all down today. Matt is here. Mark is here. Tim is here. Matt, how are you doing today?
Tim, I'm doing really good today. I'm doing much better than any BYU fan is today after 9 consecutive losses to Utah and an entire decade, the 2010s, where the Holy War was completely dominated by the dark side of the moon to the north up there in Salt Lake City. And some of you may be wondering why a good old-fashioned BYU fan is wearing red today and Utah helmet in the back here. Well, I lost a bet to Coach Noah. And that was a bad bet on my part. I figured I was going to take the L on it, but friendly bets are fun. And so big shout out to Utah youth for winning the Holy War, and shout out to Coach Noah. He is such a fanatic. Like he puts the fan in fanatic when it comes to the University of Utah. And like he told me last night on the phone as we were talking about the game, he said, "Matt, this is like a religion to me." And I'm like, yeah, I get it. Utah fans are celebrating today. So good for them. They have a great team and hopefully they do great this year.
One of the reasons I bought the house I did is that they had a little U insignia painted on the parking lot. And I was like,
and they think
I can support that.
Crazy,
but I can support that.
I feel like it was a really good bet on my part, Tim, even though I was laying some points there, about 7 points on the spread, because I graduated from the University of Utah up there at S.J. Quinney School of Law back in 2004. And I remember that was Smith's senior year. Urban Meyer was there. They went 12-0. Finished pretty high up in the polls. So, I hope Utah does good. I hope they win every game except the BYU game.
Now, does BYU see this as a sign of the apocalypse? That God has forsaken the football team, and it's just a sign of the second coming?
Yeah, this is Book of Mormon ending of the world type stuff.
BYU fans are definitely in the fetal position today. There's no doubt about it. In fact, our brother Chris, he was tweeting about how
he's not happy.
No, they're not happy.
No, the Justice household down in Emory County is not happy right now.
By the way, Friday heading into a long weekend, on markets on Monday are not going to be open on the U.S. markets, Matt. Obviously, futures markets you can get access to in the 24-hour Globex futures market. But it doesn't surprise me that we're hitting our head on resistance here and hesitating. What's your read on the technicals on the S&P?
The technicals on the S&P is just very, very simple, Tim. You're coming into a long weekend. There's not a lot of news coming out today. We do have some earnings reports to talk about, maybe a little bit of economics, but quite a slow news day over the course of the last 3 days in the market. And now you just had really good price appreciation this week, Tim. I mean, the S&P 500 this week alone is up 2.7%, coming straight back into that resistance channel right there at 2940. And if you drop this down into the intraday channel here, you can kind of see how that 2940 level, it got up above it just briefly on the overnight. So did the Dow Jones. We'll look at that intraday here in a second. But then when the cash open happened here at 7:30 a.m. Eastern Standard Time Mountain West in the Mountain Time Zone, you just saw profit taking here. And that's all I'm seeing from an intraday perspective is just really kind of just simple profit taking. I don't think traders right now, the investor class is obviously a little different, but I don't think the traders right now feel comfortable carrying trades into the weekend. I kind of feel like this is, 1985, and you got the market makers on Wall Street, and they're not willing to take trades into the overnight close. So they're going to close their positions and reopen them the following day. Well, that's kind of what I feel about the weekend right now, is that traders just don't want to carry aggressive positions coming into the weekend. And especially after a week where we had 2.7% price appreciation in the S&P coming smack dab into that resistance, kissing off that 50-day moving average. I just see this as a little bit of a slowing momentum, a little bit of profit taking, nothing to be too cautious, too concerned about coming into the weekend.
Mark, I want to bring you in on this one. Obviously, trade war news has dominated price action for the entire month of August. We sold off aggressively late in July into August. We found support. We've now put in a candle pattern that is up 3 or 4 days in a row and then down, and then up 3 or 4 days in a row and then down. Is the market neutral for you right now, Mark?
Yeah, 100%. It's just, where are the big, huge catalysts that are going to set us upward and onward? It would have to be true trade war resolution. It would have to be the Fed coming in and saying, no, we are going to keep this market going no matter what happens. Till you have these rallies, especially when they come into technical areas of resistance is resistance for a reason. There's a reason we call it that. So until you get one of the two, which you don't have today, is hard to see these, see the bullish conditions that create an uptrend. They just don't exist right now.
Ever so subtly, the Dow actually tried to break out this morning. They're a little bit different in the pattern, in my opinion. The Dow was showing relative strength a little bit. Now it hit right into the 50-period moving average, and that's where it's been neutral and flat. Again, Matt, cash open with strength, and the market is selling off, probably just hedging going into the weekend.
Yeah, I would say so, Tim. I mean, you had a little weakness on the overnight coming into the European Open here. European markets start opening up. You see that price appreciation. And I'll tell you a little trade I made last night, Tim. I'm sitting here last night and I'm watching the BYU game, and I'm talking. No, this was my night last night. I'm watching the BYU game. I'm playing zombies with, Jake Lamore from Legacy, and we're having fun just talking about the markets. And I'm talking to him about, hey, Jake, we're looking at it right here. I'm like, hey, Jake, go check out the YM contract real quick. Let's look at the kind of that 26,400 level that we were talking about all day yesterday. And I had a trigger right above 26,400 at 26,410, stop loss right underneath that. Good price appreciation right there. And then I kind of just walked away from it, put the stop loss, continued to watch the game a little bit. Obviously got stopped out right there. But then on the European cash open, it really kind of picks up steam. US cash open drives it back down. When you're looking at this on a daily basis, it is a little bit of a subtle difference, because you are right now technically above that 26,400 level at 26,410. So I wouldn't call it a breakout yet, but you're getting close there on the Dow. And, I do agree with Mark to sustain a prolonged bullish market. I'm talking 3, 6, 9 months, a year from now, you're going to have to see some degree of clarity from a trade policy. You're going to have to see some degree of clarity from the Fed as well. And we certainly could get that coming up in the next month or so, especially in regards to the Fed. But to see quick price appreciation here, that's going to be technically driven, not economically driven. So keep an eye on that resistance level at 26,400 on the Dow. Keep an eye on the resistance level at, let me get you the exact number here, right around 29.45, I would say, on the S&P. If we do break out, we could see price appreciation from a technical perspective on the hope of some type of trade deal, because we've all seen those headlines. Hope this, hope that, hope this, and it drives the market up. So you could see some quick price appreciation or price depreciation based on just kind of the news cycle or the technical market. But I don't see anything prolonged over the intermediate to primary type trends until we get clarity, like Mark talked about.
Yeah, there's no doubt about it. I do see relative weakness in the NASDAQ just on a daily basis. All the patterns look the same though, guys. I mean, they're rattling back and forth, back and forth, back and forth. NASDAQ down about 0.5%, where the rest of them are, pretty flat to break even. Technically though, Matt, I don't see very much difference here.
No, I mean, technically in the broad indexes, and, I've said it every day this week, sound like a broken record at times, but when the volatility hits here, those three indexes, the Dow, the S&P, and the NASDAQ, they're all going to do the exact same thing until we start to see something, come out from a news cycle or economics or earnings or whatever the case might be. And as the trends start to develop, at that point, they start to separate themselves. But right now, you got double bottoms and double tops here in the short term. And I will tell you guys, I don't want people to be like, oh, Chicken Little, the sky is falling here. But this pattern here does give me some subtle reminders of what happened back October, November, and December, when you initially broke those levels of support. Very similar type of trend over here to what you have over here. You have slowing momentum in your trend over here. You have slowing momentum in your trend over here. Once that violates those moving averages and breaks that horizontal support level, you see that volatility pick to the downside, and you see this double top, double bottom scenario. And then once support was violated, that's when you saw all the panic selling happening in December, when we came into the plunge protection team on December 24th with that, infamous call that Steve Mnuchin gave back in December 24th to call the plunge protection team. But when you're looking at the Dow, you see the breaking of support, and you see that double bottom, double top, and the panic sets in. When you're looking at the NASDAQ, let me get to the NQ contract here. When you're looking at the NASDAQ, break support, sees that similar type of formation. And so you're looking, when these things happen, coming back to the current market price action here, do the exact same thing. And then once the support right here is violated, most likely that 200-day moving average, or once resistance is broken through, at that point, you start to see the strength of the market start to show itself.
Is the S&P 500 developing into a head and shoulders pattern on the weekly, Matt? I mean, I don't really think it's there yet, but you do have that shoulder from middle of the year where we hit the top, and now we're kind of in the same location.
It does have the early indications of it, and I mean early indications of it. What starts the head and shoulders formation in a trend is what is called slowing momentum. Slowing momentum is the vertical distance of resistance increasing in a trend. And so as you can see, this price movement goes from 2,400 all the way up here to 2960. I mean, that's a good 260 point price appreciation in this first leg in the trend. In the second leg of the trend, you go from 2740 up to, somewhere around 3000. So, oh, excuse me, it was 460 points. I got that wrong. So it goes 460 points, and then it goes right around 230 points. And so you can kind of see it visually here, just the slowing momentum. And so when you see slowing momentum on those weekly charts, yes, that is an early indication of market weakness relative to the primary trend. But what it also could be is just slowing momentum before the market ends up breaking out again. So we are seeing the early indications of it, especially with this increase in selling during this retracement here, increase in selling during this retracement here. That is not a positive sign for the market when you have slowing momentum, increasing volume on the downward movements in price. And so yes, you do have early indications, but I'm not ready to call it a market reversal on the weekly, because if you hear me call it a market reversal on the weekly, I'm talking major market bear markets at that point. And because short-term bear markets, a lot of times those end up being opportunities to buy stock. Can we agree with that?
Yeah, for sure.
Yeah. Okay. So short-term trends that in a longer-term uptrend, opportunity to buy stocks at a discount. But when you have major market reversals, those always happen on weekly charts.
Yeah. Move on to the dollar, if you will. I want to talk a little bit about the economic data that came in today. Core PCE price index, one of the preferred inflation measures from the Federal Reserve, came in line with expectations. Personal spending actually was a little bit higher than what they thought. Chicago PMI read right neutral, Matt, 50.4. What did you see from the economic data today, number one, if anything? And number two, the breakout on the dollar is significant up here.
Well, I think the one thing we saw today on the economic reports coming out of the U.S., you had personal spending, the PCE price index, and the Chicago PMI number. The Chicago PMI number came in at a really good number today. Not relative to a great bull market, but relative to what the expectation was. The expectation was 48.1. It came in at 50.4. So a beat on that from an economic perspective. You also had personal spending, and there's certain themes that develop in the market. And one of the themes that is developing in the market right now, and you're seeing it all over the news cycle, is how the U.S. consumer is really holding up the U.S. economy. And I believe there's some truth to that. Personal spending came in at 0.6%, which is an increase over what was expected at 0.5%. It was also an increase over what was previously last month of 0.3%. So consumers are still feeling fairly confident about the marketplace. And as you can see, once those reports started coming out, you saw all this good price appreciation here. But there's something else happening here, Tim, on the dollar, not just positive economic reports coming out of the U.S. When you're looking at the euro-US dollar cross pair, that's the storyline in the entire market today, guys.
Yeah.
The entire market today is based on the euro-dollar cross pair dinging under 110 for the first time since 2017. And that is major news for the Eurozone. The Eurozone is we all know the Eurozone economically is burning right now, and you're seeing tremendous weakness in the euro. And remember, the value of a currency typically goes at the value of an economy. It's not just the ECB manipulating or the FOMC manipulating, or I know we'd like to think that sometimes, and I know some people on Twitter like to post that quite a bit, but the reality is the value of a currency goes at the back of the value of an economy. And the euro right now is just not doing very good from a European Union perspective, from an economics perspective. And you saw that break out of that bearish cup and handle pattern right here underneath that 110.50 handle. And it was just falling like a rock, coming, just getting absolutely blasted back down.
I mean, pretty soon I'm going to be able to go to France and bottled water will not cost $5. it will only cost like $3
Oh, yeah.
my American dollars.
Oh yeah,
So
it's great for people that want to go to France right now. It's great for people that want to go back through Europe right now because
it's never been cheaper to vacation in Europe.
This is the lowest level, yeah, in 7 or 8 years.
It has. I mean, just
but
17. I mean, it was at $1.04, and I was calling for pairing, but that was back in 2015, right when the ECB was just dying from a.
But look at that from a chart perspective. That shows you how much room you have. I got clear out to the downside.
Oh,
I mean, here's the thing. I sometimes I talk to traders and they're frustrated. They're like, I'm a directional trader and the stock market's doing this. Expand your ability to trade. Learn to trade a few commodities. Learn to trade a few Forex pairs. Sometimes when there isn't an opportunity, because you just love to trade Apple.
Yeah.
Like there's opportunities to do good directional trades in other markets or in other areas, maybe than just what you're looking at. And
why do you think, Mark, that people just feel like they just need to trade the stock market? Because I see that
habit, comfort, things we're used to. I
They
mean, just
know it.
basic. Yeah. I mean, the same reasons we fall into routines in regular life. You know, we get comfortable with something and that's what we do. I mean, my real life, that's what it is. I eat the same 12 foods and I wear the same 10 shirts and I do the same routine in my life. I mean, we get used to those routines.
Yeah.
And so I think that's the same thing with traders. But man, if you just broaden out a little bit that, hey, cash flow the stock market right now. And if you're looking to do some great directional trades, I mean, they happen all the time somewhere.
Yeah.
Just broaden out your scope a little bit.
Well, and some products are better cash flow right now. Some products are better directional. This euro dollar breakdown, Matt, just made me look at all the Forex pairs. There's a lot of those Forex pairs actually sitting on support. The Aussie dollar is at 0.67. A breakdown there is another trigger.
Well, the New Zealand dollar as well. But yeah. I mean, just one perfect example of what Mark was talking about. When you're looking at the S&P 500 in this environment, we get so caught up in the stock market because that's what our 401k is based in. That's what our IRA is based in. That's what's in the headlines. That's what people see on a daily basis. It's not like people are watching CNBC and looking at platinum or palladium analysis, right? They're looking at what's going on in the broad market indexes and so on and so forth. But like Mark said, broaden your horizons. This market has been a difficult market to trade in. There is absolutely no doubt about that. You know what has not been a difficult market to trade in? That market.
Silver.
That has not been a difficult market.
Yeah, they've been screaming bullish for sure.
Yeah. So
you know what also hasn't been difficult, even though it's boring? Utilities, REITs. Yeah. Here's the problem some individuals have. They get used to having a few couple good winning trades, and they're like, I'm going to nail it because I'm going to trade Netflix and Apple, and these ROIs become huge.
Or maybe they just don't have the right strategy for this, Mark. I mean, because you don't have to play the equity here. You could easily play leap options and still cash flow this.
Yeah, I mean, there's things you can do that maybe have a lower override, but you go to a weekly chart map, and sometimes like position trading in 2019, REITs and utilities has been the easiest thing in the world. You have a huge positive fundamental backdrop with the investor class just knowing that interest rates are going to continue to fall.
Well, okay, let's go on what you just said. Okay, REITs, utilities, we know interest rates are going to fall. TLT.
Go to bonds. I mean, the Trading Justice podcast that we have coming up, we're going to talk a little bit about bonds. I mean, there's areas in the market that are fairly easy to trade. Now, sometimes they're not going to give you those great returns that you get from a great trade, but man, the market gives you what the market gives you. Bonds have been easy to trade in 2019. REITs, utilities, things that are gold, silver recently, things that are reflective of shifting monetary policy in the US and around the world. These things have been easy. Some of them, are they the greatest returns in the world? No. But is it something better than banging your head against the wall in a trade war environment? Yeah.
I mean, take the boring old 20-year, treasury bond, right? Paying out at whatever the garbage interest rate it's paying out at, right? And so when people think that when they buy, TLT, they're getting paid whatever the interest rate on the year is. TLT is up 20% on the year, guys.
Yeah, I mean it's not the same as We need to do a whole big huge thing on bond ETFs.
Yeah,
sure.
to educate people a little bit better.
It's such a boring topic, but
making money. I mean,
it's important. It's important.
I mean, if I go do a directional trade on Apple or Micron, or then I have to live in the absolute fear that trade war headline number 37 is going to come out the next day. When I'm trading some of these dividend interest things that are benefiting from the Fed backdrop, I don't have to worry about that.
Well, yeah, true. But you can take that fear out by hedging too. I mean, I'm still buying equities, guys. I went long some products this week, but I also went short some products this week. And I hedge by buying more put option, keeping my delta neutral, Matt. You can still trade in those riskier assets and still add bonds. I mean, they don't have to compete with each other. You don't have to choose one or the other, right? I mean, you can add some of the conservative stuff to more aggressive stuff.
It's just the balance of how you want to approach a portfolio, Tim.
Yeah.
I mean, in those long-term retirement accounts, nobody's going to swing trade TLT.
No.
Nobody's doing that, right?
TLT, I don't know. 2019 might get me to rethink that.
Mark's going to create a day trading system on the 20.
I mean, I'm serious. I mean, go back to TLT. Look at that chart in 2019.
I'm with you.
Because generally the conventional wisdom is I buy that. But you look at that chart, look at breakouts. Look how breakouts have done. Look how pullbacks have done. I mean, I'm just saying is I've reopened my mind to trade, to doing maybe some swingish, positionish type trading on TLT.
Well, I do think having bonds in a longer term portfolio as a protection strategy in as we go through this lowering interest rate environment. I mean, we're almost guaranteed to lower 0.25 basis points in 2 weeks, guys.
Come on, let's just call it what it is. Everything's going to zero eventually.
Oh yeah, I mean, guaranteed.
Everything. I mean, that is the millennial type instant gratification world we live in.
Mark, there's a reason we're doing 50. We're thinking about doing 50 and 100-year notes now.
Like this is all insane. This absolute inability for human beings to accept short-term pain to create long-term stability. But hey, I could be the old man on the porch yelling at kids that their music's too loud and to get off my damn grass. Or I could just, as an investor, accept it, be like, this is what is happening. You see it around the world. Yeah. And do you think it's going to change? No, because the smartest people in these freaking rooms are like, we can fix everything through monetary policy.
Well, they can't, and they're going to risk hyperinflation in the U.S. by doing so. But I will enjoy refinancing my house at 0% interest rates.
Heck yeah.
Yeah, the only question on that is timing, obviously. Mortgage rates kind of found a little bit of bottom.
Kimmy is obsessed with when he should refinance.
I am. I'm projecting in my mind about 6 months from now, but I don't know. I'm not refinanced yet,
Like everything's going to zero. Like, I mean, so think about that today. If you believe what I just said, everything's going to zero, which is not an outlandish statement.
No, I've been projecting zero interest rate policy.
What do you think TLT is going to continue to do? What do you think gold is going to continue to do? What do you think dividend paying classes such as utility and REITs are going to do? Do you think they've capped out? Hell no, they haven't.
No.
There's still room up.
Well, we've been talking about this great precious metal and commodity boom recently. And when I mean recently, I mean really since a year ago recently. And, looking at your precious metals here today, silver, strong bullish uptrend. I've already done my rankings for all the commodities, currencies, and sectors for the Scout Report meeting coming up. And I'll tell you, out of all the commodities right now, I got silver at the top at a 10-yard markage, and I wanted to put it into the touchdown zone.
I was hesitant in the commodities report this weekend. I was hesitant because silver on the trade war doesn't, they don't do very well. But I mean, but silver has the monetary policy behind it that has helped send it up. Remove the trade war risk this week. and boom, silver just took the heck off because listen, there's something, investors, you see this with TLT, you see this with silver, you see this with gold, you see this with REITs, you see this with utilities. Investors are starting to position themselves to say, this is just the beginning of extremely loose monetary policy, and let's just get in.
Well, guys, I'm going to tell you, in my opinion, you will never see a 3% interest rate on the Fed fund again.
I don't think you will.
Not in my lifetime. I do not believe we'll see that in our lifetime. Once you establish a norm from a monetary policy perspective, you never, ever reach that norm again. We've seen that for 3 decades now. The high interest rate in the 1980s, 18%. The high interest rate in the 1990s, 6.5%. The high interest rate in the 2010s, 5.5%. The high interest rate in the 2010s, 2.5%. The low interest rate in the 1990s, 2%. The low interest rate in the 2010s, 0%. The low interest rate now, going into the future projecting, I do believe we will go to zero interest rates, pump in trillions of dollars in quantitative easing. And when that doesn't fix this debt massive bubble, they're going to go to a negative interest rate in the US for the first time. That's what I believe is going to happen over the course of the next, for the foreseeable future, because every country in the world is doing the exact same thing. And like Mark says, these modern monetary theorists, right, that are coming out of all the different education, they believe that they can fix any solution with money. And
they do.
And this is not something that is new, guys.
Yeah, that's not a left, right, Republican, Democratic thing. That's all of them.
That's an academic thing.
That's an academic thing.
That is not a political thing. That is an academic thing. They feel they can fix everything, but one thing they can't fix is history. Every single time in history that any central bank or treasury of any government has ever done these types of policies, it has always led to the death of the currency in every single scenario.
Yeah. Yeah, and one area of the market that's going to benefit from those type of policies are the metals markets. Gold in an intermediate, long-term, and short-term uptrend. Silver is at the 10-yard line, Matt. Platinum just went crazy this week.
That's palladium.
And this is palladium.
And palladium.
Palladium broke out today, guys. Yep. Let's not bury this lead. Palladium broke out of that 1500 level on volume, on strength, and you should ding 1600 from a technical break there. When you're looking at platinum here, platinum has just been on absolutely fire, breaking out of long-term weekly channels as you see this reversal pattern. Old support, new resistance, broke out, reclaimed that 200-day weekly moving average on massive volume as well. When you're looking at all of these precious metals, they are starting to absolutely fly. And when they look, they're like, oh man, I wish I would have bought it right here. No, you don't. You never would have. You never would have bought it right there. Oh man, I wish I would have bought it right here. Now it's overextended. If you understand these commodity booms and currency cycles and interest rate cycles, these booms don't stop in a month. They take years.
Yeah. And the trends are definitely kicking into tact. Obviously, that palladium breakout is one we've been watching for a long time. At that 1500 level was very significant. Commodity report this weekend is going to be very much a must-see type of report. Make sure you're checking it out as we go. I'll tell you, copper still is not showing strength, though, and that's that trade war risk out of China. Let's move on to the energy sector, though. Oil is down 3% today, still stuck in a range, still neutral in my opinion. I'm still leaning on that one side, but it's got more neutrality. I was a little bit more bearish a few weeks ago. Now I'm a flat neutral. Mark, what's your read? Matt, what's your read? Let's start with Matt.
Well, you bet me $1,000.
I did not.
Yes, you did. Timmy bet me on the podcast this last week. He bet me $1,000 that oil would be below 50 a year from now. So
I don't hate his side of the bet, by the way, but he didn't actually bet. He said he could do it in the market. But crude oil here, stuck in a range right now, Tim. I got a neutral rating on it right there at -40. So in the commodity market last week, we had it at a -30. I did bump it up into a -40 because you now have pivot relationships that are now increasing. So you see this support level at 52, you see this support level at 53, and you have horizontal resistance at 56.5. So when you're in an environment with an increase in support and horizontal resistance with a longer term downtrend, you got to have some type of neutrality rating on that.
Don't try to trade oil unless you day trade. That's a whole different thing. Cash flow this. It is so easy to cash flow. Listen, global growth is terrible. Oil is not going to take off without global growth. Like, it's just not. But there are a lot of bullish things on the supply side. Like, just cash flow it, learn to boomerang trade this, learn to cash flow USO, crude oil instruments. It just makes it easy. Just put a little 5-10% of your portfolio, 5% of your portfolio in USO or something. Maybe not all at once, like build up to it and just cash flow it.
Yeah. And we've been looking at natural gas all week as well. Natural gas starting to make a comeback.
Hold on, T. I was done with crude.
Yep.
So in terms of crude oil, very quickly, one of the reasons why you're seeing profit taking set in here today is you did hit horizontal resistance, number one. But with the hurricane changing its path to come kind of hit into central Florida instead of kind of that Miami area, and some fear that it would get into the Gulf Coast, it's not going to stop supply. It's not going to stop production of supply, but it might have an imbalance in demand just because, you know, when we see this, I mean, Florida people they're going to struggle from that perspective. So that's one of the reasons why it's coming down. And, you know, we have tackle trading members down in Florida. Legacy Education is down in Florida. A lot of people we know and care about deeply are down in Florida. Just be safe, everybody. Thoughts and prayers with you guys. Just be safe.
Mm-hmm. Yeah, definitely. And I mean, those hurricane plays, Matt, obviously insurance companies end up coming into play. I've seen volatility out of them, the Home Depots of the world. Stocks usually will react to that news, but the first and foremost thought is just safety for the people down there in Florida. There's no question about it. Natural gas, Matt, I still am interested. I'm not there yet. I just want to take a peek here. And we haven't got Mark's take on this. Mark, you're going to be doing the commodity report this weekend. I'm getting more interested in neutral cash flow on natural gas for the first time in some time. UNG is a good product. The NG contract, there's good futures options on it. What's your read on natural gas, Mark?
I've been talking about the potential reversals. I mean, we're right at the trend line. We're right at the trend line. 3 weeks ago in the commodities report, I said that this is what a reversal starts to look like. Now, you still need to wait confirmation and all that. I mean, if you break that trend line, then that is a huge. Now, you also are battling, let me get my moving averages on there. There's two things you haven't done on natural gas. You haven't had a sustained move above the 50-day moving average, a confirmation where it closed above and then broke the resistance level of that close above. Okay, you still haven't done that today. You're teetering. You also haven't broke the trend line yet. But you're right there on both. Literally, a move above the resistance level from yesterday, which is not too far above, would technically signal a potential reversal for the first time in 2019.
Yeah.
So you're literally right there on the precipice. But here's the thing, and this is why I will still have a negative rating on natural gas. You've been here before twice. You've been here in May. You've been here in early July, right in these situations, exactly where you are today. And both of those situations resulted in really significant sell-offs. So
can I counterpoint?
Right. Yeah.
Okay. I struggled with my rating on natural gas. I've had a negative rating on natural gas since last, December?
Mm-hmm.
Right? Whether it was negative 30, 20, or 10, it's been bearish to very bearish. I actually am putting it at the 45-yard marker. And you know, guys, for those of you who don't understand what we're talking about here, we rank every commodity, every currency, every sector, the marketplace based on the scoreboard. And the scoreboard is based on a football field, and right of the 50-yard marker is bullish, left of, bullish, some degree of bullish, left is some degree of bearish. And if I put it at the 45-yard marker, and what we're going to do later on today in the scanner report meeting, everybody, is there's going to be about 10 people, the coaches of tackle trading, they're going to rank everything, and they do everything by themselves. And then we average everything out, and then we have a discussion on it. And sometimes we modify those and so on and so forth. So I'm looking forward to a really good discussion on natural gas here, because I see the exact same things Mark sees here.
Mm-hmm.
The only subtle difference that I would say is you have slowing momentum in that trend. right here on that weekly chart. So you do have some slowing momentum in this trend on that weekly chart, very similar to what we talked about with that head and shoulders formation on the S&P 500. When you're looking at this from a technical perspective, you're smack dab into that resistance level right there. And that's going to be a tough resistance trend line to draw. That is a very consistent one. But I'm starting to see some strength coming into here. Moving averages are starting to cross back up above. And so I'm seeing a little bit of a strength. So I did put it at the positive 45-yard marker, but I'm looking forward to what everybody else is seeing there. Because
and I'll have it at the negative 30.
Look at all the volume coming in too, though.
I mean, you weren't there in the scattering report meeting. Tim and I got into it in the first week of July on natural gas because, once again, there were some of that thing. But that is just an easy to see trend line. I mean, moms that don't know technical analysis and dads that don't know technical analysis are like, yeah, I can see that trend line. They just draws. I mean, it's just so easy for traders to see.
Yeah, I track this one every day. It feels different, though. I know that's just watching the technicals, reading the technicals. We did break a little mini resistance on the daily chart. We are above the 50 and the 20 period moving average.
But you haven't had confirmation above the 50.
I got it. That's why I'm not putting it at the positive 30.
But one thing you do have different here is you had a breakdown off a snapback, a bear retracement, and it got stuck in the mud at $2. It did not confirm that.
No, and I said in the commodity report 3 weeks ago, I was like, this is what a reversal starts to look like. Yeah. So, like, and
that's why I put it on the 45, because I kind of see the same thing Tim's seeing, but I also kind of have a feeling. And I know we shouldn't be trading on feelings. I get that. But sometimes feelings are based on.
I have a feeling that Buffy the Vampire Slayer will show up at my door.
Oh my God.
That's called a fantasy and not a feeling.
They're the same freaking F words.
No. Different F words, I would say.
F word Friday. Here on the halftime report.
Friday fun day. There's no doubt about it. And by the way, earnings roundup real quick here, Matt, before we move into our coach's mailbag. And welcome out, everybody. If you're watching our show here on a Friday, laissez-faire, kind of laid back kind of day, not for BYU fans. We talked about that earlier. Some earnings companies coming out, Marvel, Dell, and Workday yesterday after the bell. Workday from a chart perspective, guys, I don't know if you saw this breakdown. That WDAY breakdown is significant. Actually going to go right on a bear watch list for me. Matt, what earning stocks kind of grabbed your attention?
I'm looking at three of them here. I didn't really look at Workday's earnings, but ULTA, Ulta Cosmetics here, just an absolute just beating.
Wow, I didn't see that.
Tyson beating somebody down in an alley back in 1988. That's what happened to Ulta here. Neutral coming into it. This is absolute company. If you invest in it, I do not invest in it, but if you do invest in it, this is what's called an IBD top 50 growth type company. High P ratios, high valuations. You always have to protect these types of stocks. And this stock just got absolutely just obliterated. They came in at 2.76 on their EPS versus 2.79. Guidance, 1.7 billion versus 1.7 billion versus the revenues, but they had a big lowered guidance here, Tim, and that just got absolutely just crushed. Opened up down 21%, down 29%, down $100 on the day so far, and this is what could be the beginnings of what's called a catastrophic gap when you have such a nasty earnings report. This is like a CEO coming out with handcuffs on, let out by the FBI. Mm-hmm. That's a catastrophic gap. And it's going to be very interesting on this weekly chart to see this weekly level of support right there at $227 to see how that gets impacted in the short term. So what a nasty, ugly gap on Ulta. And Ambarella here, another type of growth type company, AMBA, and Ambarella was a Tackle 25 stock for a few years as they did a lot of business with Apple, trended a lot of very similar to the way Apple did. Once Apple did not renew that contract, we pulled it from the Tackle 25. But they came in right now at a really good number on earnings per share, Tim. This is a stock that I would put on a watch list again because it's a great cash flow stock as well. They came in at 21 cents on the number versus the expectation of 2 cents. So a destruction on earnings per share for an Ambarella. They came in at 56.4 billion, not billion, they're a small cap company, 56.4 million versus 52.1 million. They beat on revenue. And triple whammy, guys, you know what the triple whammy is. They also did a big increase on guidance as well. So a beat on the number, a beat on revenue and a beat on guidance. And you saw what happened. It gapped up, broke out of all levels of resistance. And that's kind of holding firm here. Let's see how that behaves over the next few days to see, kind of get a better feeling on the gap range, because the cash opened. Now you're dojing, not a lot of price action after the cash opened. When I see that, I'd like to see a little bit of data coming out before I make any type of decision here. And then the last one here is Dell Computers. I remember when I bought a Dell computer many years ago, but here's Dell Computers here. They came in at 1.89 versus 1.20. So utter destruction on earnings per share, 23.4 billion versus 23.4 billion on the expectation. And then, so they kind of just came in line, but they did have an increase in guidance. This reminds me of a little bit of this should gap fill, maybe reversal potential here in Dell. So if this is a stock you track, watch that come back down, fill that gap, and let's see how it behaves from a reversal perspective.
I like gaps like that to sell like bear call spreads against, the day after the earnings, tracking volatility, playing earnings types plays. I do like playing off those gaps. That Ulta gap is significant. I didn't actually see that $100 move on that thing. Unbelievable. Good reminder that those big stocks, you better hedge them going into the
high PE stocks, growth stocks that have a tendency to gap on earnings. All those need to be covered. But when you're trading Ulta, Tim, you should know better than to leave something uncovered going into earnings, because Ulta's not Coca-Cola.
That's right. That's right. And last thing we're going to do here today, by the way, is go through a couple of questions from our clubhouse. Mark,
I just want to say, you know what? You don't have to worry about earnings on crude oil, gold, silver, commodities.
Currency.
One of the reasons I love commodities.
ETFs.
ETFs. Earnings is a pain. And I've seen it wreck individual investors because they didn't protect themselves. There's a lot of areas. If you're like me and I just hate earnings, I hate it with a passion because I don't like to gamble. There's a lot of areas in the market that you can learn.
I love earnings. I love earnings plays. I love everything about them. There's so many different ways you can play them creatively. And that's kind of, I guess, the nature of the markets, guys. One person's strategy might not fit.
Yeah, but you don't like
personality.
Yeah, but you need to clarify for someone that doesn't know what you're referring to. You're not talking about holding through earnings uncovered.
About straddles,
talk about trading,
butterflies, and
specific strategies.
Yeah.
Vega, baby, no doubt about it. Mark, you got a question or two for us from the clubhouse?
Yeah, just from the Tackle Trading Clubhouse. Just going to read a couple questions off that we've had. Once again, stocks like AMTD and VLO triggered the contingent price, confirming that the price of the stock is moving down, but my orders do not fill because the price of the strategy is now higher than the limit price initially set up. Do you think that instead of a limit order contingent on the price, I should use stop limit orders without contingency?
So trading AMTD and Valero from the option report, they saw the trigger on a contingency. And this one was from Javier in our clubhouse, it looks like. So they missed a fill from their order, and they're wondering if they should just use stop to market. I don't think so. No, one of the problems with contingent to option market orders is that you have no control over the fill. I'd rather miss a trade or two, Matt, and make sure that I get good fills when I do get in than just chase prices on a market price.
Especially options, right? If we're talking stock, there's a lot of different ways we can do it in stock, but if you contingent to market in options, and we all know what happens the first 15 minutes of the option trading day, bid-ask spreads get wider, especially in volatile conditions. It can trigger into some bad scenarios. So no.
And we have a lot of gapping situations with the trade war, don't we? Where news will gap things up, and you'll have a price you want to get in. Hey, look, what Matt just said, golden. Miss a few trades because of the gap. Don't stick to your plan.
Same thing on stop losses on options, by the way. I don't like stop contingencies to market either for the same reason. I don't like the fill prices that you get when you go to a market price. So I prefer a limit on the contingency when I trade option orders like that.
I could understand an argument on stop losses contingent to market, though.
Yep.
I can understand an argument because if you're getting blasted, you want to get out to you. If you're stop contingent to limit and it gaps over that,
Yeah, but if you spend such a small amount when you're directionally trading, you can kind of control that theoretical risk through position sizing. It's preference.
Well,
It's
I
not a
get
mandatory
that, but
thing.
but okay, not to get in an argument here, but if you're doing that, if you're position sizing such at a small level, then why are you putting a stop loss in the first place? You're basically just saying I'm willing to lose the premium on the option if I'm wrong.
Correct. It's just personal preference. When I do stop losses on options, they're always contingent to limit. That's just the way I trade them. Yeah, it's my preference.
I love it when BYU fans get testy with one another after a loss.
Oh, there you go. All right, Mark, any others?
Next one, step system. Clarification entry on a bullish retracement. In the step system, do we enter on the high of the signal candle or on the high of the confirmation candle plus ATR?
That's an interesting question. And this one's from Carl.
Let me take this one. It's very simple. It goes back to who you are as a trader, right? I mean, there's not just one way to trade the step system. There's conservative versus aggressive entries. And so if like, for example, in creating a pivot, you have three candles that really kind of create the pivot. You have your bounce candle, which is your in a retracement. It's that candle that's coming back down into support. Then you have your signal candle, which is that slowing momentum candle. Typically we see at a support level where, the traders stop locking in profit and, buyers start coming back in at those key support technical catalysts that we talk about in the step system. And then you have your confirmation candle. Well, technically speaking, there's two triggers on there. Aggressive traders can absolutely trigger on the signal candle. That's number one. And they would use their whatever personal rule they have. There's three different, rules you can apply there, and they're all percentages of the ATR. Mm-hmm. So you have the aggressive trader who says, I'm willing to take less probability to get a better return and take on a little bit less risk by getting into it on the signal candle. And then the conservative trader says, well, I'm willing to give up a little bit of that return. I'm willing to take on a tiny bit more risk, but I'm going to get a bigger increase in probability by doing it on the confirmation candle. So no trading system is do this, this, and this. You can't remove the decision-making process from the equation for the traders, Tim. You can do your best, and I think the step system does a fantastic job of really kind of, showing the traders exactly what they can apply, but they still have to make those decisions whether or not they want to be aggressive or conservative. And sometimes, Tim, I'm going to wait for confirmation, and sometimes I'm not. I mean, it's at the discretion of the trader, and it's not just what I'm seeing in the stock guys. When I'm making a decision to be aggressive or conservative in a swing trade, I'm looking at the market, number one.
Yeah, I was just thinking that,
Yeah, it's not just the technical situation. Mr. Market's going to play a role in that.
Module 3 of the step system goes through a lot of that, Matt. One thing I really like about the way that you did the video and the way that we laid out the course is that it does give people different choices and kind of really thoroughly teaches those different dynamics. Signal candle, confirmation candle.
One last thing. I'll adjust the ATR rule too to fit what I see in the market. In a hot market, man, I might do a 10% of ATR above the resistance channel on a breakout in a hot market. In a volatile market, I might wait for confirmation. So again, the one thing you can never do from an education perspective is you can lay out the rules, you can teach people how to go through the critical thinking process, but you cannot remove the decision making from the trader. It is up to the trader to make those decisions. They have to have that personal responsibility. And the more you do it, the better you become at it. That goes back to prospect theory. If you're in your first 3, 6, 9 months as a trader, your skill set in the quickness of making those decisions is certainly not going to be as well established as somebody who is in it for 2, 4, 5, 6, 7 years, or somebody like Mark or yourself or Noah or Gino who's been trading multiple market cycles over the last 1 to 2 decades. So it's just a matter of just going through the process, putting your butt in that seat, making trades, learning from that experience, and then growing over time.
Mm-hmm. Next.
All right, last one. In the midst of everything else melting down these days, I just stumbled across a news article that LIBOR is set to die in 2 years. Since this is a benchmark for interest rates, and we are instructed to monitor interest rates as part of our research for investing, Can anyone explain how we should account for this since the banks are already in the midst of gearing up for changes? Does this mean the interest rates won't be stable across international investments? And how will this affect the calculations we do when evaluating what and how to trade? Can I get an expert answer or at least an informed opinion, please?
I'll tell you, I don't get too concerned at them replacing LIBOR with something else, Mark. That doesn't really kind of change the way I approach the market. We're talking about the way banks communicate with other banks. That's the overnight rate. In America, it's the ARRC rate. So, and if you don't remember, that one of the reasons that kind of led to the Bank of London and the London Stock Exchange kind of, getting away from LIBOR is basically there was a lot of controversy and scandals around what was happening with that rate that's been established since the 1980s. And so they're just simply moving to a different type of rating system. And, it's not something that I'm too concerned about, to be perfectly honest. There might be some volatility, but this is something that we've known for 2.5 years, and it really hasn't had any impact on the news cycle.
I mean, you think about the trades that you do today and what might happen. How many computer programs and traders are thinking about is it LIBOR or LIBOR?
I've heard both. I say LIBOR, but LIBOR I've heard it as well.
How many are thinking them about their day-to-day decision makings today? It's like Brexit. There's these things and the effects later down the road. Listen, you could come up with a million things why everything's going to go to hell, years down the road. But nobody's thinking about those today. Nobody's influencing those decisions today. It's not affecting the price of the market or stock today.
It's how banks communicate with one another, Mark. And the only interest rate you need to worry about in the U.S. is the Fed funds rate.
Fed funds rate.
That's what you need to rate.
Go to the SPY real quick. Like all of the things, hyperinflation, interest rate policy, this and that, like all of the million things, debt, mounting debt. I mean, sometimes we love to get all of these things in our head because they're kind of interesting to think about. Until support breaks, short-term support breaks, all of the doomsday things that might happen in the future don't matter.
Yeah.
Like it's why learning how to read a chart and then taking those protective actions. I believe, do you believe something really terrible is going to happen in the next 20 years? Because I do.
Of course.
But I'm not going to obsess about it today. I will pay attention to support levels. When they break, I take defensive action.
Yeah, trade what you see.
LIBOR was a rate for 30 years. I understand the question, but I mean I'm around this every day, guys. I look at the Fed funds stuff every single day, and I geek out on that. And I'm going to tell you right now, when that came out I want to say it was 17, but it might have been 16. When that came out, the Bank of London and the London Stock Exchange was going to do that. It had a 1 day, like in the news cycle, and then it was gone.
Yeah, I mean, it's the 1 day effect. Yeah. And you have a lot of that.
Yeah, it was just 1 day and then it was gone.
Who was the guy that was advising before Larry Kudlow? Who was the guy that was in that role for Trump that everybody loved?
Oh, man. Gary Cohen?
Everybody loved him. And then Cohen quit, and everyone's like, market went down like 350 points that day.
Yeah.
The next day, it was up 325.
It was a 1 day move.
A 1 day move. Like you have these 1 day news events all the time.
Mm-hmm.
And then nobody cares about it.
Mm-hmm.
Yeah, that's kind of how I feel.
All right, boys. Very, very good job today. A couple of programming notes, Matt. We are off on Monday for Labor Day, and we're going to be taking the weekend off for that. And no tackle trading shows. Another one, the market recap. We're going to put it on the shelf and retool that. Talk about that for a minute, if you will.
Yeah, we just feel like we don't have the demand yet for 2 market type recap shows. The halftime report, I feel, does a wonderful job getting everybody up to speed on what's happening in the market on a daily basis. And I just don't feel like we need an extra show 3 hours later to update them on what happened in the next 3 hours. So I feel like the halftime report does a wonderful job. And, I know a lot of people love Coach Frank, and that's just going to allow Coach Frank to come over here to the halftime report a little bit and join us here on, routinely once or twice a week to give us his perspective on, breakout Frank and the breakouts he's looking at trading and so on and so forth. But that doesn't mean we're not looking to retool something and bring something else out there. Because we want to continue to enhance our programming at Tackle Trading and giving people, the quality of analysis and education that they're looking for on a daily basis. And so we're having internal conversations on that second show that we're going to do, and whether it'll be a every day of the week or 2-3 times a week or whatever the case might be, the topics and whatnot. I put something over there in the clubhouse, and we had some wonderful suggestions from hashtag Team Tackles. So we're looking to take the month of September to retool, and hopefully we can bring out another live show on YouTube for our subscribers on YouTube. So,
and one last thing, I dropped a link in the chat for the Cash Flow Club replay. Mark, you did that one last night on covered call management in a bearish environment. I haven't seen the replay yet. How'd the show go? Yeah,
I always enjoy talking about covered calls in a good cash flow environment. I have really gravitated towards cash flow in 2019. It's fitting my personality. I'm becoming more and more laid back every day. Mm-hmm. I start thinking about retirement, for the first time ever. And the concept of cash flow just really gravitated towards 2019. And we certainly have market conditions that support it.
Check it out. We're going to be putting some good reports together.
I want to make sure everybody's clear. Coach Frank is not gone. He's going to be hanging out with us in the halftime report, and he's most likely going to play a major role in whatever next live show we do. And Frank does a wonderful job. Breakout Frank is amazing. And guys, he's going to be there live today. Today's going to be his last one. So let's show up and support Frank tonight.
Very good. All right, guys, we're done. We'll see you guys next Tuesday when we come back after Labor Day. Enjoy your long holiday weekend.